ServiceNow just completely shattered the high end of their guidance across like every single top line and profitability metric for the second quarter of 2026.
I mean, it was an absolute blowout across the board.
Yeah. Total revenue came in at $3,987 million, which is up 24% year over year.
And subscription revenue specifically hit $3,877 million. That's a 24.5% jump.
Right, and jumping straight to the bottom line, non-GAAP net income reached $930 million.
Which translates to 90 cents per share, basic and diluted.
But, and we really have to flag this immediately, GAAP net income was a much smaller $298 million, or just 29 cents per share.
Yeah, that gap is huge. But still, the forward-looking metrics signal that management expects this momentum to, completely hold.
Oh, absolutely. They raised their full-year 2026 subscription revenue outlook to a range of $15.76 to $15.78 billion.
Right, which represents a 22.5% increase.
Exactly. And for the upcoming third quarter, they are guiding for $3,975 to $3,980 million in subscription revenue.
So the market reaction was swift, right? Shares popped immediately in aftermarket trading.
Which is why we are here today. The mission of this deep dive is to unpack exactly how they generated those numbers for you. We need to look at the underlying segment performance.
The margins, too.
Right, the margins and management's really aggressive commentary on AI. And most importantly, we are going to flag the key risks that you, as a retail investor, absolutely need to watch.
Because just looking at a top-line beat is, well, it's never the full story.
Definitely not. So let's move directly into where that revenue is coming from.
Yeah, because top-line revenue really just tells you what was billed in the past 90 days. But for a SaaS company, the real valuation is all about future cash flow predictability.
Locking in massive enterprise commitments.
Exactly. I mean, remaining performance obligations, or RPO, hit $29.0 billion.
Wow, up 21% year over year.
Yeah. And current RPO, which is the revenue expected in the next 12 months, sits at $13.2 billion.
Also up 21%. I think the best way for you to visualize this at home is think of their $13.2 billion CRPO, like a massive coiled spring of guaranteed cash flow already locked in for the next 12 months.
That's a perfect analogy. The customers have already legally signed the contract.
Right. And what's driving that 21% growth is this huge shift toward enterprise consolidation.
Oh, massive deals. I mean, they closed 123 transactions, over $1 million in net new annual contract value in just this quarter alone.
Growing nearly 40% year over year.
Yeah. Plus, they now have a total of 658 customers with over $5 million in ACV.
It's incredible, but there is a specific mix driver here that we need to scrutinize, right?
Yeah, the U.S. federal demand.
Exactly. Management noted their 150 basis point guidance beat was partially driven by strong federal demand, pulling some on-premise subscription revenues forward from Q3 into Q2.
Right, because of the accounting mechanics for on-premise software.
So my question is, does pulling forward Q3 federal revenue into Q2 artificially inflate this quarter's optics? Or is the underlying enterprise momentum strong enough that it won't create a hole in Q3?
Well, it's a great question. It absolutely inflates the Q2 optics a bit.
Right.
Which is why that 150 basis point beat needs like a little asterisk. But the fear of a Q3 hole ignores the sheer scale of their backlog.
That coiled spring we talked about.
Exactly. When your guaranteed base over the next 12 months is over $13 billion, a few large federal deals shifting by one quarter is basically a rounding error.
It's just timing.
Yeah.
And they raised full-year guidance anyway.
Which confirms the total pie actually grew.
Okay, so top-line growth is secure. Let's transition to the bottom line, because high growth is only sustainable if it translates to real operating leverage and cash flow.
Yeah. And looking at Q2, their non-GAAP subscription gross margin was 80.5%.
And non-GAAP operating margin was 29.5%.
With free cash flow coming in at $634 million, which is a 16% margin.
Which brings us to management's profitability framework. CEO Bill McDermott claims they are operating at the rule of 56.
Right, which combines their constant currency sub-revenue growth plus their free cash flow margin.
And he said they are targeting the rule of 60 plus by 2030. They also specifically pledged to reduce stock-based compensation to less than 10% of revenue by 2029.
Yeah, which is a huge deal for retail investors.
But let me push back on these non-GAAP metrics. I mean, it's a nice promise to get SBC under 10% by 2029, but looking at this quarter, there's a massive gap between GAAP net income of $298 million and non-GAAP of $930 million.
Oh, it's staggering.
Driven largely by $655 million in stock-based comp. Are they relying too heavily on non-GAAP adjustments to paint this rule of 56 picture for investors today?
Honestly, retail investor frustration on this is entirely justified. Wall Street accepts non-cap metrics because SBC is a non-cash expense, right? That doesn't hit cash flow today.
But the dilution is real.
Exactly. When they issue over $650 million in stock in a single quarter, they are expanding the share pool.
So the rule of 56 looks a lot less heroic if you use strict GAAP operating margins.
It really does. But, management publicly committing to drive SBC below 10% by 2029 is a signal that they know the market demands real GAAP profitability as growth naturally slows.
Right. Now, the reason they are able to command such a premium today, despite that dilution, ties directly to management's explanation for their dominance.
The AI catalyst.
Exactly, their aggressive AI monetization. ServiceNow AI actually crossed $1 billion in annual contract value in Q2.
Which is a huge milestone. I mean, McDermott called their AI control tower the market standard.
He also noted that agentic deployments of ServiceNow AI increased ninefold in just 9 months.
Yeah, and CFO Gina Mastantuono said something super interesting. She was like, in an environment where most enterprises are still searching for AI's ROI, ServiceNow is the platform delivering it.
Because of these new product rollouts, right, like ServiceNow Auto and their new autonomous AI specialist for IT and risk management. But every single SaaS company on Wall Street claims to be an AI platform right now to justify their multiples. So does hitting $1 billion in AI ACV prove that ServiceNow has actually solved the monetization puzzle that their peers who are just slapping chatbot labels on legacy software are still struggling with?
I really think it does, and it's because of the difference between passive chatbots and agentic AI.
Right, because a chatbot just fetches a summary of a document.
Exactly. But agentic AI actually routes work, verifies security credentials, and physically executes tasks to completion autonomously.
So it's replacing direct labor hours.
Yes, that's how a company justifies a multi-million-dollar contract. If the AI autonomously resolves 30% of help desk tickets, you can literally freeze hiring for that department.
Right, which proves real ROI on a spreadsheet.
Exactly. Hitting that $1 billion in ACV proves enterprises are verifying that math.
Okay, but we need to ground this optimism and pivot to the specific risks management flag to make sure you get a balanced view of what could derail this.
Yeah, because they were explicit about a primary headwind in their guidance.
Foreign exchange or FX.
Right. Since March 31st, 2026, the U.S. dollar has incrementally strengthened.
And management explicitly estimated that this total FX impact will create an approximately $35 million year-over-year headwind specifically for Q3 2026 CRPO.
Which happens because they generate so much revenue overseas, but report in U.S. dollars.
Right. But if the dollar keeps strengthening, that $35 million headwind could easily snowball. Furthermore, with their growth so heavily dependent on signing massive $5 million plus enterprise contracts, aren't they acutely exposed to any sudden tightening in corporate IT budgets if the macro environment shifts?
Customer concentration at that massive level is absolutely their biggest structural risk.
Because it just takes one CFO getting nervous.
Exactly. If 5 or 10 of these massive deals slip from Q3 into Q4 because of macroeconomic fears, suddenly that predictable momentum breaks, and they miss Wall Street consensus.
Which leaves us with a really fascinating, broader strategic question for you to mull over today. With ServiceNow proving that massive enterprises are willing to pay a premium to consolidate their operations into one unified AI control tower, does this signal the beginning of the end for smaller, niche SaaS tools?
It's a great question, because chief information officers don't want to manage 50 different vendors.
Exactly. If ServiceNow is successfully absorbing IT, HR, security, and data analytics into autonomous workflows, the real story might not just be about ServiceNow's stock, but the existential threat it poses to every other vendor fighting for space in a company's tech budget.
It really is the ultimate consolidation play.
Definitely something to keep your eye on. Thanks for tuning in, and make sure to follow the show for our daily earnings coverage.